Financial analysis is the backbone of M&A due diligence and negotiation. It empowers lawyers to uncover hidden risks, validate value drivers, and structure deals that protect client interests, leveraging both traditional analytical rigor and cutting-edge AI tools. 1. Due diligence. Systematic risk discovery. A. Objectives and approach. Uncover hidden liabilities. Identify undisclosed debts, off-balance sheet exposures, and legal noncompliance that could impact deal value or post-closing risk. Verify assets. Confirm ownership, valuation, and encumbrances on key assets. Assess financial health. Evaluate liquidity, profitability, leverage, and operational efficiency using robust financial ratio analysis. B. Key skills and tools. Systematic document review. Scrutinize financial statements, tax records, contracts, and regulatory filings for completeness and accuracy. Use industry-standard checklists to ensure no area is overlooked. Financial ratio analysis. Leverage ratios, debt-to-equity, interest coverage, flagging solvency and bankruptcy risk. Profitability ratios, gross, operating, and net margins, revealing cost management and pricing power. Liquidity ratios, current and quick ratios, assessing ability to meet short-term obligations. Efficiency ratios, receivables and inventory turnover, spotting operational weaknesses. AI-powered tools. Platforms like Kira Systems, Luminance, and eBrevia automate contract review, anomaly detection, and risk flagging, reducing manual effort by up to 50% and uncovering issues that might be missed by human reviewers. MindBridge AI Auditor and Power BI with AI integration analyze financial data for irregularities and fraud. C. Practical application. Data room analysis exercise. Review a sample data room to identify missing documents, inconsistencies in financials, and potential deal breakers, e.g., pending litigation, regulatory investigations, or material contract breaches. Key finding. A multidisciplinary, technology-enabled due diligence process is essential for surfacing hidden risks and informing negotiation strategy. 2. Negotiation. Structuring and securing the deal. A. Objectives and approach. Inform key deal terms. Use due diligence findings to tailor representations, warranties, price adjustments, and indemnity provisions. Balance risk and reward. Structure mechanisms, earn-outs, escrows, that align incentives and protect against post-closing surprises. B. Key skills and techniques. Valuation techniques. Discounted cash flow. DCF projects future cash flows to estimate intrinsic value. Comparable company and precedent transaction analysis. Benchmarks target against peers and past deals. Scenario analysis and benchmarking. Model the impact of different business outcomes, e.g., margin compression, working capital swings, on deal value and IRR. Use industry benchmarks to set realistic targets for earn-outs and working capital adjustments. Deal structuring mechanisms. Working capital adjustments. Ensure the buyer receives a business with sufficient liquidity. Price is adjusted if actual working capital at closing deviates from a pre-agreed target. Earn-outs. Bridge valuation gaps by tying part of the purchase price to future performance milestones. Requires clear metrics and dispute resolution processes. Escrows. Hold back a portion of the purchase price to cover potential post-closing claims. Indemnities. Specify when and how the seller must compensate the buyer for breaches or losses, with negotiated caps, deductibles, and survival periods. C. Case study example. Working capital adjustment negotiation. Buyer and seller agree on a 12-month average as the target. At closing, if actual working capital is below target, the price is reduced. If above, the seller receives an additional payment. This mechanism protects the buyer from unexpected liquidity shortfalls. Key finding. Financial analysis directly shapes negotiation outcomes, enabling precise, data-driven structuring of price, risk allocation, and post-closing protections.